Hello, and welcome back to the channel. I'm Algabot, your guide to automated trading strategies for MetaTrader 5. In today's video, we're taking a close and educational look at an expert advisor called Range Expansion Index Pullback. This strategy is built around a lesser-known oscillator from DeMark called the Range Expansion Index, and it's designed as a with-trend pullback approach. By the end of this walkthrough, you'll understand how the indicator measures directional range, how the entry and exit rules are constructed, and how the code brings it all together. Remember, everything here is for educational purposes only. Let's get started. So what does this expert advisor actually do? At its heart, it's a trend-following pullback system. Rather than trying to pick tops and bottoms, it waits for an established trend and then looks to join that trend after a temporary pause or dip. The tool it uses to time those pauses is the Range Expansion Index, often written as the TrendPeriod. This is a distinctive oscillator because, unlike the RSI or the DeMark, which mostly compare closing prices, the Range Expansion Index measures the signed expansion of each bar's range. It pairs every bar's high and low with the levels from 2 bars earlier, and it deliberately zeroes out any bar whose range has fully detached from recent price, such as a spike or a gap. The result is a reading bounded between -100 and +100 that reflects genuine, connected directional range flow. A strongly positive value means the range is expanding upward as buyers push into new ground. A strongly negative value means the range is expanding downward. Readings near zero suggest the market is balanced or consolidating. The strategy combines this oscillator with a moving average trend filter. It will only consider a long trade when a price EMA is rising and price sits above it, and it will only consider a short when that same average is falling and price sits below it. This keeps every trade aligned with the prevailing drift. In terms of who it's designed for, this is an educational example aimed at traders interested in disciplined, rules-based trend continuation, and it's intended for liquid, trending instruments such as major foreign exchange pairs, gold, or index products, on intraday to swing time frames. It runs on whatever single time frame you attach it to. As always, trading involves real risk, and losses are a normal part of any strategy. Let's walk through the exact logic step by step. Everything is evaluated on completed bars, so the strategy acts once per bar after the previous candle has finished. The first check is the trend filter. The expert advisor calculates an exponential moving average using the TrendPeriod parameter, which defaults to 50. It compares that average now against its value several bars earlier, using the slope lookback, which defaults to 5. For a long setup, price must be above the average and the average must be rising. For a short setup, price must be below the average and the average must be falling. Next comes the pullback itself, measured by the Range Expansion Index over its summation length, which defaults to 8. In a healthy uptrend, a normal dip drives the oscillator down into negative, oversold territory, below the negative range expansion threshold, which defaults to 40. The actual entry condition looks for a recovery. On the previous bar, the reading was below -40, and on the current completed bar, it has climbed back up to or through -40, and that bar closed higher than it opened. When all of those line up, the strategy signals along. The short side is the exact mirror. The reading pushes above +40 during a rally inside a downtrend, then falls back down through +40 on a bar that closed lower than it opened, and the strategy signals a short. Now for risk control, which is really the focus of this design. When a long is opened, the stop is placed just below the recent swing low, scanned over the swing look-back bars, with a small buffer. That structural distance is then clamped to a tight band defined by the ATR and the ATR stop multiplier, so risk per trade stays small and bounded. The take profit sits at the stop distance multiplied by the reward-risk ratio, which defaults to 1.8. Once a trade moves in your favor by the break-even R amount, the stop is nudged to lock in a small gain near the entry. After the trade reaches 1 full R of profit, an ATR trailing stop takes over, following price at a distance set by the trail ATR multiplier. The stop only ever tightens, never loosens. Only one position runs per magic number at a time, using fixed lot sizing. Let's read through the actual MetaTrader code on screen. At the top, we have the input parameters, which are the dials you can adjust. You can see the range expansion index period defaulting to 8, the range expansion threshold at 40, the trend period at 50 for the EMA, and the slope look back at 5. Below those sit the risk settings, including the ATR period, the stop multiplier, the reward-to-risk ratio at 1.8, the break-even level, and the trailing multiplier. Now look at the two signal lines. The long trigger is true only when we are in an uptrend, and the previous reading was below -40, and the current reading has climbed back to or above -40, and the bar closed higher than it opened. The short trigger is the mirror. It requires a downtrend, the previous reading above +40, the current reading back at or below +40, and a bar that closed lower than it opened. When the long condition is met, the code sets the stop below the entry by the clamped stop distance, and the take profit above it by that same distance multiplied by the reward-to-risk ratio, then calls trade.buy. On the short side, the stop is placed above the entry, the take profit below it by the same reward-to-risk multiple, and the code calls trade.sell. Both sides share the identical structural logic, simply flipped in direction. Let's bring this to life on the chart. In the lower panel, you can see the range expansion index oscillator, moving between -100 and +100, with the dashed lines marking +40 and -40. On the price chart, the blue line is our 50-period trend EMA. Let's start with the long trade. Across the first 3 candles, price is climbing steadily, each candle closing higher, and the trend average is sloping upward with price above it. That satisfies our uptrend condition. The oscillator is comfortably positive here, confirming that range is expanding upward. Now watch the 4th and 5th candles, which form a normal pullback. Price dips, pulling back toward the rising average, and the oscillator drops sharply into the green zone below -40. This is the temporary pause the strategy is waiting for, not a reversal, just a breather inside a healthy trend. On the very next candle, price closes back up and the oscillator recovers, climbing back through the -40 line. That recovery, combined with the still rising trend and a bar that closed higher than it opened, is exactly the long condition. You can see the buy entry marker appear right there. The stop is tucked just below the recent swing low, giving a tight, structural risk. From there, the following candles push higher. The range expands upward again, and the oscillator lifts back toward positive territory. Price runs into the take profit target, marked several candles later, with the reward set at 1.8 times the initial risk. Along the way, the break-even lock and the ATR trail would have been protecting the position. Now the market rolls over. Around the peak, price stalls, then begins to slip below the trend average, and that average itself flattens and turns down. We've shifted into a downtrend. Watch what the oscillator does during the small rally that follows. As price bounces, range expands upward again, and the oscillator pushes up into the red zone above +40. But this is a rally inside a downtrend, a counter-trend bounce, and the strategy treats it as the mirror of a pullback. On the next candle, price closes lower than it opened, and the oscillator falls back down through +40. With the trend average falling and price beneath it, that is the short condition, and the sell entry marker appears. The stop for the short sits just above the recent swing high, again structurally tight. From there, price resumes its decline, the oscillator sinks into the green zone, and the move carries down to the take profit target, once more at the 1.8 reward-to-risk distance. Notice the symmetry of the whole thing. In both cases, the strategy did not try to catch the exact turn. It waited for the trend to be clearly in place, waited for a temporary countermove to stretch the oscillator, and then joined the trend only when that oscillator recovered back through its band with a confirming close. That is the essence of a with-trend pullback, and it's why the entries sit at favorable prices with naturally compact stops. Of course, not every signal behaves this cleanly in live markets, and losing trades are an unavoidable part of any approach. So there we have it. Today we explored the Range Expansion Index Pullback Expert Advisor, from the way DeMark's oscillator measures directional range, through the trend filter and the pullback recovery entry, to the structural stop, the reward-to-risk target, and the break-even and trailing management that keep the risk tightly controlled. We also read through the actual MetaTrader code for both the long and short sides. Remember, this video is educational content only, and it is not financial advice, a recommendation, or a solicitation to trade. Every strategy carries real risk, and losses are always possible. If you found this walkthrough helpful, Please give it a like, leave a comment with any strategies you'd like me to break down next, and subscribe for more analyses. You can learn more over at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.